In June of 2019, a Wall Street Bets user named Deep Fucking Value began buying long-dated January 21 calls. What that means is in June of 19, this person was betting that the stock would go up by January of 2021. He spent $50,000, which, by the way, today is worth about $25 million.
By the way, Chamath, we should just highlight that there are forums where individuals that are trading stocks talk to each other and share tips and promote things to one another. That's where this was taking place.
Yeah, and by the way, those forums exist in the professional organized world too,
right.
Amongst hedge funds. I've been invited to idea dinners where we all get together and we talk about the ideas that we have, and we're all expected to do fundamental analysis. But some of those ideas are actually momentum-driven ideas. And a lot of the biggest dislocations in the market, just as a setup here, have been because of momentum-driven trading by organized capital. Okay, so we've been stuck with this for a while. So this guy, Deep Fucking Value, posts this, and every month since, he's posted a screenshot of his position, and he's titled it GME YOLO Update. August 22nd of 2019, Michael Burry, who is this guy famous from The Big Short, who's the guy that caught the mortgage thing, he discloses a 3% position in the company, and he highlights that 90% of GameStop's 5,700 stores are free cash flow positive. That's like pretty good. He urges a buyback, and he notes that the company was trading at or near net cash levels. So he's making a deep value oriented fundamental thesis as well.
Chamath, I think also it's worth saying what GameStop is, because even my wife asked me, what the hell is GameStop last night? GameStop is a retail store where people buy video games. I used to go to the mall all the time and buy video games there. And consoles and headphones and other stuff.
And they'll buy back your old games.
And so the stock got beat up over the last couple of years as people stopped going to malls and stopped buying stuff in stores, and everyone thought the company was going to die. And so these guys observed that maybe there's real value in this company and it's making money.
Digital downloads are now the standard.
No one buys DVD ROMs anymore or anything like that. So
and the Chewy founder, who is very successful at e-commerce, came in to run the company.
I'm about to get there. That's the best part of the story.
So June 19 was the original post. August 22nd of 19, Michael Burry comes in and says, I'm long. Then a year later, August 31st of 2020, Ryan Cohen, who's the founder of Chewy, takes an almost 10% position in GameStop. About 2 or 3 weeks later, on September 19th of last year, a member of Wall Street Bets writes a post on GameStop, and he notes that GameStop has 120% short interest, which I'll get to in a second, so hold on. What does that mean, 120% short interest? And he defends the company as a result of a few things. He says, number one, there's a new console cycle coming, just as Jason mentioned. Number two, consoles are not going all digital immediately. GameStop loyalty programs have 55 million users. They have a strong balance sheet. Ryan Cohen just bought a stake. And the shorts were underwater and would be forced to cover if the stock ran up. He predicted the convergence of all these factors would lead to a big squeeze. Now, November 16th of 2020, Ryan Cohen writes a letter to the GameStop board, and he urges the company to conduct a strategic review and share a credible plan to capture market share in the gaming industry. He said that they need to evolve into a technology company that delights gamers and delivers exceptional digital experiences. I'm just quoting here. Not remain a video game retailer that over-prioritizes its brick-and-mortar footprint and stumbles around the online ecosystem. November of 2020, someone in Wall Street Bets highlights that a hedge fund called Melvin Capital was going long GameStop puts. What does that mean? That they are synthetically shorting the stock by buying the right to sell it at a different price in the future. Okay? And that they had been long that position for more than 4 years. So all the way going back to 2016. Fast forward to now 2021 of this year. January of 2021, GameStop strikes an agreement with Ryan Cohen and adds him to the board of directors and gives 2 of his affiliates, his former COO and CFO of Chewy, also 2 board seats. They collectively, bring their experience in e-commerce, online marketing, finance, and strat planning. The stock goes up 13% on that day and closes at about $20 a share. 1 day later, and then over the next day after that, so for January 12th and 13th of 2021, There's a ton of activity around GameStop in Wall Street Bets and now in Discord and in StockTwits, claiming that Ryan Cohen is going to be the savior. And then by January 14th, so 3 days later, the stock closes at $40. So now it's up 125%. So now comes the setup, the pros versus the Joes. From January 12th to today, there has basically been a battle by institutional investors on one side, shorting GameStop, and retail investors on the other, buying the stock and also buying the right to buy the stock, or what's called call options. And this is what has created this crazy nonsense we've seen. So on the institutional side, after, retail drives the stock up, the institutional guys are like, hey, wait a minute, Ryan Cohen's an idiot. This company is fucked. Fuck these guys. They have too many, cyclical and secular tailwinds. And they become so massively short that the infrastructure that's supposed to even count all the shares can't keep up. And now they are short more than the actual number of shares that actually exist. So now they're 140% short. The Joes, retail, they start to aggressively purchase all these call options. And on January 13th and 14th, this price keeps ticking up. Then a bunch of quant funds and momentum hedge funds notice all this activity, and they also participate on the long side. And then over the past 7 trading days, we have traded over $100 billion of stock in GameStop, which is well in excess of what retail can support. So here's what's crazy to realize. A bunch of value-oriented, non-computerized, non-quantitative hedge funds short. Retail notices a dislocation, initially fundamentally, but then momentum-oriented buys. Other hedge funds realize, also buy, and this is what's created this massive short squeeze. On January 19th, Citron Research, a research firm that basically tries to, find shorts in the market, announces that they were short GameStop, and they gave 5 reasons why it should go to $20. The stock was at $35.50 on January 19th. Then over the next 2 days, GameStop calls hit an all-time high, and it runs a 2-day rally of almost 70%. And this is what really starts what's called a gamma squeeze, okay, which is what we saw in the first part of this week. So January 25th, Ken Griffin, Stevie Cohen, they inject almost $3 billion into Melvin Capital, the firm that was short, $2 billion from Citadel and $750 from Stevie Cohen. Stevie Cohen had $1 billion in it from before. And then now all of a sudden, the squeeze keeps happening. The squeeze keeps happening. And then it starts to spill over to the rest of the market. Now, all these hedge funds, these original hedge funds, they are getting called by the bank saying, hey, wait a minute, you've run over your collateral limits. You need to post more collateral. We need more money in your bank accounts. So now not only do they have to cover GameStop, they have to cover all their other shorts. So those go crazy. And they have to sell their longs. So now they're selling Facebook, Netflix, Alibaba. And so those things are going down. That accordion is what's been happening in the market in the last couple of days.
Is this any different than what every brokerage firm does? We've been talking about get long, get loud for
it's not. It's not good. It's not good for the brokerages to be doing that at all either. I'm not defending that. It's just when you see moves like this, it's a little crazy. And I wonder what Doug Parker is thinking. I wish we could get him back on to ask him what he thinks about his stock being up better than 50%, because I would think that makes a company pretty hard to run, too. How do you live up to those expectations now?
Oh, but they're not expectations at all. I mean, look, the reality is you just have to run your company and do your best. It doesn't change the fundamentals of the company at all. It so many respects is window dressing. And if you are an owner of American Airlines, if you're an owner of GameStop, hopefully, prior to all this, hopefully you owned it for a good reason and you believe in the company. And all the not even manipulation, all the swings in the price of the stock, it's all just mishigas, right? I mean, if it's a good company, it's a good company. If it's a bad company, it'll end up going out of business. And, the people who, bought it just to speculate, some will make money, some will lose money. But that's just the way the market's always worked. The only thing that's really changed is the speed and the density and the reduction in friction for smaller traders to trade. That's the only thing that's changed.
Yeah, I mean, look, it's good news in terms of crowdsourcing, being able to have the same heft that some of these really big whales have on their own, if you can get this together. But we don't know who some of the people on the chat boards are or in Reddit are on these threads who are saying some of these things, too. Do you worry that some of the Wall Street guys could get behind that, some of the big guys, and manipulate those things?
Yeah, but it's not really manipulation. It's absolutely no different than what has always happened, Becky. It's just these folks are picking things where, heavily shorted stocks. They'll go to low float stocks because they know they can flex and show off, and let people see what's going on. But look at it the other way. What if they go after companies that are really good or maybe smaller companies that are have a great social mission and get people not just to buy them in mass and quickly so the stock price skyrockets, but also to hold on to them or, in cryptocurrency terms, hodl them so that, that company really can grow based off of the valuation of that stock. So I think now it's just a flex. They picked the right place to show off with these heavily shorted stocks. And, hopefully they'll go to good companies too and help them grow. And we'll see a positive side of this that hopefully will have long-lasting effects.
I think that what you're seeing is essentially a pushback against the establishment in a really important way. You have a lot of people, and I would encourage anybody who is dismissive of this thing to go into Wall Street Bets and actually just read the forums. And I think that you're going to see three kinds of posts. The first kind of content are a lot of people doing some incredible fundamental diligence on companies, trying to think about long-term value. And in my opinion, many of them are doing as good and, frankly, a better job than a lot of hedge fund analysts that I work with. That's number one. The second are a lot of people who believe that, coming out of 2008, what happened was Wall Street took an enormous amount of risk, and they left retail as the bag holder. And a lot of these kids were in grade school and high school when that happened. They lost their homes. Their parents lost their jobs. And they've always wondered, why did those folks get bailed out for taking enormous amounts of risk and nobody helped and showed up to help my family? And then the third thing is a realization that instead of having idea dinners or, quiet whispered conversations amongst hedge funds in the Hamptons, these kids have the courage to do it transparently in a forum. And I'm not saying all of it is perfect by any means. But I think it takes an enormous amount of faith in the system to be that transparent, to talk about things, and then for each individual to make their own mind up and to do things, whether it's to buy and to sell. I think that what it proves is this retail phenomenon is here to stay. There are 2.7 million people inside of Wall Street Bets. I think that they are as important as any hedge fund or collection of hedge funds. And I think the most important thing is that in a world of zero interest rates and quantitative easing, I don't know how you can run a typical hedge fund strategy and make money anymore. Because, for example, when you looked at GameStop, a normal person would say, how can you have 136% short interest? How can you be short 40% more shares than actually exist in the world? To a normal person, that doesn't make any sense. But to a Wall Street mathematician, that's the game that has been played for years. And that game came undone.